Well, ladies and gentlemen, good morning and welcome to the Experian Quarterly Business Credit Review for Q3 2023. My name is Gary Stockton. I work in marketing for Experian with Brody. Before we get started, I want to make sure that we cover just a few housekeeping items. We're going to get done with these in just a second. If you would like to follow along, we've got a copy of the PDF of the slides in the handouts area. If you've got your phone handy, want to snap a picture, but don't worry if you don't have the slides right now. Our follow-up email is going to include a link to that and the recording afterwards. During today's webinar, we're going to be discussing key findings in the Experian and Oxford Economics Main Street Report for Q3 2023. Our presenters today are Brody Oldham, Vice President of Commercial Data Science for Experian, and Michael Pierce, Lead US Economist with Oxford Economics. Brody leads a team made up of statistical consultants, scientists, modelers, and engineers with diverse skills who provide clients with leading-edge analytics-driven information solutions, services, and data visualizations of actionable insights. He writes and speaks on behalf of Experian about trends in credit markets. Michael is a key part of the US macro team at Oxford Economics, responsible for forecasting the US economy, writing analysis on thematic topics with a particular focus on the consumer outlook and Federal Reserve policy. He speaks and presents regularly to clients of Oxford Economics, and his work is frequently quoted in national and international media. We encourage you to submit questions using the Q&A applet in the tool panel. We'll try to leave some time at the end to answer them. If not, they will be routed to our experts and responded to following today's webinar. And now I'd like to turn things over to Michael Pierce from Oxford Economics.
Thanks, Gary. So what I wanted to discuss today is the outlook for the US economy. Obviously, the third quarter that we saw was relatively strong for the US economy, continued resilience of the US consumers, but it's been a particular theme throughout this year. But really, the key point I want to leave you with today, which we see on this next slide, is just that the economy is set to slow from here. We don't see this strength that we saw in the third quarter persisting. The early signs we already see for the fourth quarter are already beginning to bear that out. So we're starting to see signs that consumer spending has begun to tail off in October. We're also seeing signs that higher interest rates are beginning to hit more heavily on business investment as well. So I think there are three key forces that we see driving this slowdown. I'll get into them more as we go along, but essentially we think the legacy of higher interest rates and headwinds to consumer finances, together with tightening of fiscal policy next year, are going to be the three key drivers, which see economic growth slow essentially to a standstill by the beginning of next year, and then a relatively subdued gradual recovery as we go throughout 2024. So on the next slide, starting with the first point, I think, is that this time is a bit different from previous downturns we've seen. So obviously, the headline GDP numbers are very strong, but when we look underneath the hood of the economy, we see very different stories playing out in different industries. On the left-hand side is our attempt at kind of mashing together all the high-frequency data that we get on the economy, so essentially telling us a more timely look at how the economy is doing than the GDP numbers. What we can see from that is that the economy has already begun to slow a bit from the strength that we saw in the third quarter. A lot of the recent data have begun to weaken. It's consistent with an economy that's slowing, but not yet near a recession. But as I said, this time looks to be quite different from previous cycles. And so we have this approach at Oxford Economics where we look at where we are in the business cycle for each individual industry, and I show that on the right-hand side. And really, I think the story of this year has been outright recession for the construction industry. A lot of the manufacturing sectors have been mired in stagnation throughout this year. And it's really the strength of the services sector, particularly consumer services, that have been holding up the economy. I think you can see that as a combination of trends of strong consumer income growth, but also some shift away from goods and towards spending on services that we're still seeing coming out of the pandemic. So how we see that changing over the next year or so is that as interest rate cuts come into view, perhaps towards the second half of next year, we start to see a turnaround in some of those hardest hit sectors, while we get a further slowdown in some of the more lagging edges of the economy, particularly the services sector. So an interesting sectoral story that's played out this year and is probably set to reverse going into next year. So of the three key forces we see shaping the economy, I think tighter monetary policy and the legacy of higher interest rates is going to be a key one. On the next slide, we see pretty much on the front lines of that is the property sector. So we're seeing obviously activity levels in the housing market at recessionary levels, deep recessionary levels. There's been a deep freeze in terms of housing transactions, particularly in the commercial real estate space as well. So obviously the big hit to demand is coming because of much higher interest rates and tighter credit availability. We're seeing that play out primarily in terms of transactions. Because a lot of this debt is fixed terms, a lot of existing homeowners are not moving. So we're seeing a lot more activity shifting towards new construction. So home construction still holding up relatively well. But as the impact of the latest increases in mortgage rates feeds through, I do expect those sectors also to come under more pressure. Because we've not had a big pickup in inventory, because we've not had a big enough downturn in the economy to force anyone to sell, and because a lot of existing homeowners are reluctant to give up low fixed rate mortgages, we've not seen much of an impact in terms of house prices. So I think this is another factor kind of cushioning the blow from tighter monetary policy for households. Just the fact that house prices themselves haven't really declined, and we don't see declines, broad-based declines at the national level. Very modest, more stabilization in house prices over the next couple of years at the national level. But obviously within that, you've got regional stories playing out as well, particularly in the West and the South, which saw some of the biggest run-ups in prices. You're starting to see a bigger hit to demand, a bigger rise in inventory, and therefore more of a correction in prices. So flat at the national level, but in some of these markets, particularly in the South and West, we're seeing outright decline. So maybe a case for a bit more weakness in those sectors in those regions coming through. The second factor I think that is going to shape the economy over the year ahead is what happens to consumers. So in this next slide, you can see just how strong the if we go to the slide after, we see how strong some of the tailwinds have been for the consumer this year. Really, I mean, the two fundamental trends I see is, first of all, the strength of consumer income growth this year. Real incomes have rebounded because inflation has fallen, but wage growth has remained relatively strong. We've also seen a bit of a boost from government policy here because we've also had large increases in social security benefits that came through early this year. All of that's been supporting real income growth, which has been very strong. As we head into next year, I think that situation is going to turn around. A lot of the disinflation that we see ahead is going to be driven by weaker wage growth itself. So essentially, there's less of a case for weaker inflation. The disinflation we see from here boosting consumer spending. And in fact, I think, if anything, consumer income growth is set to slow from here. We have smaller adjustments to social security payments coming through in January of this year. But we also see a weakening labour market, particularly a slower pace of job gains, driving a further slowdown in household income growth. What's more, I think the consumer sentiment has been pretty weak all year. The latest signs on consumer sentiment are suggestive of a further slowdown in consumer spending, which we see on the right-hand side of this chart. This is an economy where income growth is slowing but not collapsing, and the confidence just isn't there to go out and spend. So I think that's one part of the story. But on the next slide, we see the other big factor which has been supporting consumer spending this year is the fact that households have been very comfortable to run down savings. So households accumulated a large stock of excess savings during the pandemic, which have been gradually spent down over the past few years. But really what we're seeing now is that the saving rate has fallen to what we think are unsustainably low levels. So the household saving rate has rarely been as low as it is today in recent history. So that makes a case for households likely to save more in future and therefore spend less. So not only is income growth weaker, but households are going to be saving a greater share of that income as well. So it's a double whammy for consumer spending growth in our view. And really, when we look at the picture of where those excess savings still are, there's still a substantial pile of savings left over from the pandemic, but what we see now is that they're more concentrated among higher income households who are less likely to spend it. And in fact, the other factor I think going on here under the scenes is a lot of those savings were initially held in very liquid form. So a lot of households had a lot of money sat in their checking and savings accounts. What we see today, the situation is quite different. A lot of those balances in checking and savings accounts are being drawn down, and really a lot of those excess savings are now being held in what might more reasonably be called wealth products. So people have shifted into higher yielding money market funds, treasury securities, or even invested in the stock market. So a lot of these funds that don't appear to be available to be spent. So I think a lot of that boost that we've seen over the last few years from this rundown in savings is set to slow and even set to reverse over the next couple of years, over the next year or two. The third factor I want to draw your attention to on the next chart is the impact of tighter fiscal policy, which I think is an underappreciated factor driving the economy. This year, we saw a big loosening in fiscal policy as some additional spending was agreed and fed through, but also as tax payments fell back. And really, when we're heading into next year, we see a renewed fiscal tightening coming onto the scene, reflecting the tighter spending agreements reached, the bipartisan spending deal reached earlier this year, but also reflecting the rebound in tax payments. And the interesting thing here is that usually in an election year, what you see is fiscal policy get loosened as spending is increased and taxes are cut. This time around is the exact opposite. So heading into the election year, we've got more of a drag coming from fiscal policy. So I think we've got the impact of tight monetary policy, tighter fiscal policy, and also some of these headwinds to consumer finances beginning to build, which all three combined, I think will drive a weaker economy in the coming year. Now, that being said, I don't think it's all doom and gloom for the economy. I think this is an economy that has a lot of structural strengths as well. So I don't think it's likely that the economy falls into outright recession. And I think if there were a recession, it would likely to be a relatively mild one, simply because households still have relatively strong balance sheets. I think the same is true of firms as well. Both households and firms took advantage of the period of low interest rates to refinance at lower rates. Household debt and business debt is at relatively low levels as a share of incomes compared to previous cycles. And really, we only really see big corrections and big recessions in the US economy when there's been this overhang of debt or signs of overinvestment in the economy. And we've really not had that heading into the pandemic. A lot of these more structural points are looking a lot healthier than they did in the run-up to previous big recessions. So I think relatively limited, a weak year ahead for the economy, but relatively limited downside, and certainly nothing approaching the scale of the pandemic recession or the 2008 global financial crisis is on the cards. So on the next slide, the key question amid a weakening economy is just how much further there is for inflation to fall. And I think we're cautiously optimistic that inflation will continue to decline over the next year. I think the drivers of that disinflation look very different. So obviously over the past year or so, if we look on this next slide, a lot of the drivers of disinflation have been weaker goods prices as supply chains have normalized, and also much weaker rental inflation as some of the extreme jumps in rental prices as the housing market adjusted post-COVID have fed through. We know from leading indicators in both those sectors there's probably a bit more good news to come in terms of weaker rental inflation and softening supply chains, which should feed through to weaker core inflation. That's good news. But I think a lot more, the bigger question for us is the remaining kind of last leg of inflation, and the leg of inflation that the Fed is most concerned about is in the labor market. So on the next slide, we can see how that has progressed over the past year, pretty much as well as it could have done. What we've seen is a lot of the tightness in labor market conditions has come out. So the balance between labor demand and labor supply on the left-hand side here, indicated by the job openings rate, has really come back a long way without a big rise in the unemployment rate. So the good news there is that you're getting a lot of the normalization in labor market conditions, which is driving weaker wage growth without a big rise in the unemployment, which is going to threaten the overall economy. So that's been relatively positive. The problem is it's just been too gradual, and so far has not been enough to drive inflation all the way back down to the Fed's 2% target. And on the right-hand side here, I show, just there's probably more good news baked into the cake in terms of weaker wage growth, which will drive down services inflation. But really, there's a lot further to go. Wage growth at the moment is running at a rate of about 4.5% a year. For the Fed, they want to get wage growth down to somewhere closer to 3.5%. And that's a combination of the 2% inflation target and 1.5%, which is trend productivity growth in the US economy. So wage growth of around 3.5% would seem to be the level consistent with the Fed's 2% inflation target. And as long as wage growth is running above that, the Fed can't be confident that inflation is going to return all the way back down to 2%. So I think we do need to see more weakness in the economy feeding through to a slightly weaker labor market before the Fed has enough confidence that it's on track to achieve its 2% target. So I think looking ahead for the Fed on the next slide, I think the Fed is probably done hiking now. Inflation's fallen far enough that it is confident that it has raised interest rates to a sufficiently restrictive level. But I think it will. So I don't think the Fed is going to hike interest rates again. They're meeting next week. I expect them to leave the door open to another rate hike. They don't want to cut that option off, but I don't expect them to raise rates again this cycle. But really, what we've seen from financial markets over the last couple of weeks is just a real rush to start pricing in rate cuts, perhaps as soon as the spring next year. I think that's off base. I don't think the Fed are going to be in too much of a hurry to lower interest rates. The way I think about this is usually the Fed are cutting interest rates in response to weakness in the real economy. I don't think that's going to be the justification this time around. The Fed will be cutting rates in response to falling inflation, and they'll be cutting rates because they want to normalize policy to a more normal settings, remove some of the tightness that we've seen in monetary policy without necessarily moving to much looser policy. So I think they're going to be very cautious. When you listen to how Fed officials are speaking as well, they're very cautious that they don't want to repeat the mistakes that policymakers made in the 1970s, where in response to falling inflation, the Fed was too quick to loosen policy again, and they let inflation reaccelerate. And really, that got baked into higher inflation expectations, and it became much harder and much more costly for the Fed to bring inflation down in the future. So I think the Fed are going to be very cautious as they move to cut interest rates. We don't think they're going to do that until September of next year. And even when they do, they're likely to cut rates only very gradually from there. So I think that is, we do see looser monetary policy on the horizon, but when it comes, it's likely to be very gradual. So therefore, we don't see much of a stimulus or impetus to the rest of the economy from falling rates. I think that process is going to be very gradual. So we've got a subdued year ahead for the economy, and then only a gradual recovery from there. So I think that's going to be key in shaping a lot of the trends that we see in the credit markets over the next 6 to 12 months. So now I'll hand over to Brody to talk through what we see in the credit markets.
All right, thanks, Michael. It's great to have you with us and really present some very interesting insights. Certainly, an easier story than we've heard over the past couple quarters, which is certainly good for us as we're looking for our economy to normalize here, to give us a chance to get back into our growth mode versus an exposure limiting type of a mode, certainly in the credit markets as we move forward. So, hearing Michael speak to the U.S. economy with some of the factors that will still be at play as we enter 2024 into our next year, and we look at some of the factors that will impact small businesses, it's good to hear a little bit of that softening language. So as we look at the next few minutes together, we're going to look at where our focus will be as far as consumers and small businesses. The focus of the next few minutes again will be small business performance, and here at Experian, one of our key goals is to bring all small businesses, no matter how small, micro, to the sole prop type of a business. We want to bring those into view for financial markets so they can gain low-cost funding as they go forward and really become visible as a business, separating out that consumer portion for that guarantor of their consumer credit from their small business credit. And what that does is it really brings both sides up, helping you to have a good consumer credit score as well as a very good small business credit score. That gives you ease of funding both in your personal life if you need to get a car, and we'll talk about some of that today, or a mortgage, and good small business credit to help you go out and buy a piece of equipment or have a line of credit so that you can continue your day-to-day operations, even create some additional cash flow in times of just a tight market where consumers may slow down their spending a bit. And we heard a little bit of that from Michael. We'll show you a few trends as we come forward. But one of the things that we focus on is small business credit. Here at Experian, we're going to dig into our small business credit database. This contains millions and millions of small businesses, the trade lines that they have, so how they're interacting with financial markets. It talks about some of the challenges that small businesses are having in repayment of their debt and the way that they're engaging to acquire some of that debt. So we use this data together with some non-traditional sources and, of course, news that we're hearing outside just within the market. We bring all that together to provide some insights for you today. So what I'd like to start with is the consumer outlook, how consumers are performing. And Michael talked to some of that. When we think about a consumer and the way that they're engaging small business and the way that they're performing, we look at the sentiment around the consumer. And Michael talked about that consumer sentiment and how it's been kind of low, but we've seen some increase. You'll see that on the left-hand chart, the blue line toward the bottom. That's your consumer. And the consumer, even though they've had cash in their pocket, we've had some stimulus. The talk track that we've had over the past few quarters has been really that they're seeing inflation, prices of eggs, milk, gasoline for their cars, and diesel for their trucks has been going up. And so that's really caused a decline in their confidence as far as what they're expecting out of the market. But what we've seen in the past 2 quarters or so is that some of these energy prices have started to come down. We saw some metrics at the beginning where it looked at some of the shelter rental pricing coming down, which is really good. Remember, that's what created for the Fed the big challenge when inflation was so high that more than 2% of inflation was created by that shelter cost. And so to get down to their 2% target, we really were waiting for this long tail of real estate pricing and certainly rental pricing to start coming off. And that gives that opportunity for inflation to come down even more toward their 2% target and gives some relief for consumers. And that's why we're seeing that consumer confidence start to come up a bit over the past 2 quarters. Now, what about the small business, that purple line, pink line up at the top on the left-hand chart? Well, it's been pretty steady. Now, it's come down a little bit as fears of a recession kind of bounced in and out over the past year, but cash flows have still been good. Consumers have still been spending. You can see that spend metric over to the right, still been spending. And when consumers spend, small businesses feel good because their cash flow is still intact. They're not borrowing to make up the difference, any gaps in their cash flow. And that keeps them feeling good and looking toward investing in the future. So as we go to the next slide, let's see, when we talk about consumer spending, let's look at how they are as far as a balance sheet. And we talked about wage growth coming down, savings, declining a bit. What's remaining for that consumer to spend in, who has really been a challenge, certainly for the low income segments as we came into 2023. Those have really been the segments that have been the most impacted. What that means when we're evaluating this is when you start to have less savings, start to have less wage growth, but inflation is still high. You have to utilize the credit products that are available to you to fill in the gap. And certainly with the spending behavior that's continued to have a high velocity, you're going to need that utilization of a credit product to keep the volume of your spend at a high level. Now, when we look at credit products, that second chart over from the left-hand side, we really see two big trends here. What you'll see is the purple line that's dropping precipitously in the middle. That's our mortgage originations. So as home prices have been rising, we see inventory still pretty low, as Michael spoke to, interest rates high. You have less of that volume moving. That means less originations for the mortgage market. We've continued to see some of that slowness in new builds, availability into the inventory numbers. National Association of Realtors always comments on this as we've gone to try to get those construction projects to continue to move. We've seen some volatility in some of the materials, access to those, and the cost, and so we've seen some slowness here, certainly from mortgage volumes in the credit market. Now, the other trend to look at here is the stabilization of credit in both unsecured personal lines as well as credit card. We've seen them level out as far as origination. Some of that is due to a pullback of some of our financial institutions as they look to limit exposure, so not going into as many originations there, but also consumers have a lot of credit at this point. They've had really good scores, had access to credit, were able to pick up an additional card if they needed to. So that's normalized and leveled out a bit. So we still continue to see pretty good performance, not accelerating growth in consumer cards, but continuing to be pretty strong. Now in our auto market, we're certainly seeing some changes. From a consumer perspective, again, the inventory in the auto market has been relatively limited. In 2023, that inventory picked up by about 80 or 68%. And so good inventory numbers. We're seeing good spreads there. Certainly margins have remained pretty good for our dealer markets as we go forward in manufacturing. So that's stayed at a pretty good level. It's affordability at this point, and the ability to get that consumer into a vehicle has been a little bit more difficult over the 2023 year. And so we see that leveling out as well. So originations, as we see the used car market, certainly the price is dropping there. I had a son that had to buy a car, and just in the past year, still prices are elevated on used cars as we go forward, but they are dropping pretty well, down about $500 to $750 on average for used cars pricing over 2023. So starting to drop off, which is good for a market that really is in need of some replacement vehicles. Vehicles are staying on the road a lot longer, and so the need to replace those vehicles is certainly out there in the market. So we'll look for potentially some special pricing as inventories continue to pick up for consumers. So that should, over the next year, help to increase some of the originations for the auto market, certainly from a consumer perspective, and that'll help our businesses that are in that supply chain for auto continue to move forward and potentially stay at a stable point during 2024. Now, when we look at originations, you're building this credit. How are consumers doing on repayment practices? How are you repaying your debt? Are you keeping up with it? or are you having some difficulty keeping up with the bills? So consumers, what we've seen is the velocity of those delinquencies picked up. Now at the end of the summer, they slowed down a bit. We had just a good cash flows happening for consumers. You know, as they were paying down debt, wage growth has continued to increase, but delinquencies are on the rise. And when we look at the overall curve, what we would have expected to see without a pandemic event occurring over the past couple years is that with a strong and heating economy, this is where we would expect to be from a delinquency perspective. We're kind of meeting our curve. So as we dipped with the pandemic, if we drew a straight line and said, where do we expect delinquencies to be once we reach this point? We're to that inflection point, really, where we're hitting. This is where delinquencies should be with the type of growth that we've seen in the market and the health of consumers right now. Now, does that mean that with delinquencies rising, you know, we're going to keep originating at the rate or offering the same lines of credit to consumers if their delinquencies are going up? Well, if you look to the far right chart, this is looking at balance stability and credit line increases. And what we've noticed over the past few quarters is that those increases have normalized. We're at the point where some of our lenders are limiting their exposure, and so not increasing at the same rate that they would have in pre-pandemic years or in the year following the pandemic, as credit was expanding from its initial freeze point. So we are seeing credit lines limiting until we get into next year, really waiting to see what the market is going to look like before we open up or expand into lines for that consumer, expand the exposure, certainly from a leveraged consumer perspective. All right, so we've looked at the consumer and how well they're performing from a health point of view. If we go to the next slide, what we'll take a look at is how they are being viewed, so how they're spending. If you guys have been watching, certainly Black Friday, I don't know how many of you stayed up late to go out and do a little late night Black Friday shopping. Not as many stores open as there have been in years past. Really, the stores opened around where I live in Dallas here around 5 o'clock in the morning. So nothing really opening at 2 or 3 where you're standing in the cold and shivering with a blanket over you, waiting for a TV or waiting for some type of new toy that's coming out, certainly for your kids. So retail has been a little different. We've seen a lot of our small businesses and even our larger retailers push their seasonal shopping a little bit earlier in the year. So if you guys were in a Home Depot or Lowe's toward the end of the summer, you were already seeing Halloween decorations up. Christmas came up certainly around the Halloween time frame. We're already seeing inflatable Santas out there during that time. Most of the shopping is going to be done prior to Thanksgiving and Black Friday, right in that time frame. So that weekend, Black Friday to Cyber Monday, really where retailers were looking to capture most of the sales for the holiday season. And they've been doing that more and more as they look out into the future and worry that the consumer's spend would start to slow as we got till the end of the year. What they've been doing is opening it up a little bit earlier to capture every dollar that they can before they get so close to the end of the year. So we have seen retail sales continue to be positive. You know, some of the growth statistics were between 3 and 4%, and that was the expectation that we would see through the whole holiday season. Adobe tracking actually saw some increased numbers even from that, up to about 7%. So we'll see when we get the finalized numbers. Those are kind of some projections that we were seeing out of what was being called in from this weekend of spend. But as we get into the end of the year, we'll see if it really normalizes back down to about a 4% growth, which wouldn't be bad for us for this year. So that's pretty good. Now, what's been helping small businesses? We look at inventory growth. That's really slowed down. New factory orders have been pretty slow. Durable goods orders are down across the US. So we're seeing that retailers and wholesalers were limiting their orders to restock what they had in inventory. They were selling what they had in current supply, and they weren't offering as many discounts as they have in years past. because they were able to limit and continue to draw out the inventory that they already had. Well, that had some downstream impacts on our supply chain participants. So certainly trucking over the past year has been a big hit, and even through the last quarter, we saw yellow trucking go out of business. That was a big challenge. We've seen a lot more of these sole prop truckers have a lot more difficulty making their payments on the trucks because the shipping rates have dropped so much over the past year. We've seen them go for, from a pandemic time frame where a container coming from China to the west coast of the United States was $25,000 or more for a single container. Now it's below, almost below $1,200 per container. So a significant decrease in that. That means these truckers and those that are handling the volume that's coming through, they're getting less for the pickups, and that means that there's less money out there for the transportation industry. Means that they're not paying as much, and some of these that were counting on that are not able to make some of their bills because their income is just not to the level it was right after the pandemic, and we were really seeing the ramp up in retail spending. So that's going to be a challenge, and we're going to see that certainly across several industries. And when we break this out by industry, we're going to see some of those trends hitting the delinquency levels. But what we should look for is here as we come into the end of our calendar year here in December, we will see a continued ability of the consumer to spend. We will see their savings down and their utilization rates going up. And I spoke about that a little bit earlier. I think from a small business perspective, when we see some of those rising and more being put on credit cards, consumers are going to think about, they've had some training over the past couple of years to say, all right, I know what my credit is. They're monitoring their credit a lot more. They can see that as they raise up to those levels of 30% to 33% utilization on their cards, it begins to impact their credit score. And so they're thinking about that. That means they're going to make fewer purchases from a volume perspective. And so again, we're going to see factory orders and inventories continue to be lower. What does that impact? Not only trucking, but warehouse space, the cost in warehouse, the cost in inventories will start to decline. And it will open up some opportunity for certainly lower cost warehouse space. That again impacts construction and new construction on warehouse and commercial properties, which you guys should watch as we go forward. We are certainly seeing a trend in commercial real estate, whereas the space is no longer needed. We're certainly seeing that and go back to work in the warehouse and inventories. That means the price of these go down from an equity perspective. When those that are leasing or owning a building go back to refinance or re-up to their lease, the price goes up because the interest rate is a little bit higher on the money that they'll look to use to enter into that binding agreement with the owner. And as that goes forward, we'll see more instability in the commercial real estate market. So I think there's some downstream impacts that we're going to see just from the way that consumers are spending. And their consumers are a big driver in the US economy. So when we go to the next slide, we've talked a little bit about the holidays, what our expectations are. When we think about commercial lending, when we look at how small businesses are performing, not only in the way that they're looking at debt for the next couple months, but also how their repayment activity is happening. So we talked about some of the slowdown effects that we're seeing in consumer spending, still elevated, but starting to slow. When we look at small businesses and what their expectations are, they're a little less likely to grow. That means that originations are going to level off a bit, not be at the same velocity that they've been in the past, where you really see a ramp up, certainly in the holiday season to buy. And so you have retailers and wholesalers going out and getting loans so that they can fulfill inventory requirements for the season. So as we look at unsecured debt in the top left-hand corner for small businesses overall, we see that it has normalized, stabilized a bit. We also see that the credit lines have been declining Now remember why the credit lines are declining. We are having a ton of small businesses enter the market, new businesses. So about 35% of the Experian consumer credit portfolio has been in business less than a year. That's a lot of emerging businesses. If we see more of a slowdown and an increase in unemployment over the next couple months, we'll see more small businesses start, continue to occur, and we're up around 400,000 a month. It's a ton of small businesses coming into being. That means when lenders look at these businesses, they're not going to offer them the same level of credit line as an established business that's been around 5 to 10 years. They're going to offer them a lower line. And that's why we're seeing this trend continue in a downward position, limiting the exposure from lenders. Also, small businesses just younger, so they're not getting the same lines as an established business in the market. Now, from a delinquency perspective, we are seeing delinquencies on the rise, just as we did for consumer. One of the things that you'll notice probably toward the summer and early part of 2023, we saw a big spike in the southern United States where delinquencies are really rising faster than the rest of the US. That's where a lot of those new emerging small businesses at the beginning of the boom for new business, emerging businesses was happening. That was happening in the South. That's where the delinquencies are hitting now. And so that's why we see that elevated trend certainly hitting more in the South and the rest of the US. Now that's started to normalize, and we're seeing those delinquency levels level out across the rest of the regions. So the South is coming back in line with what our delinquency expectations are for the rest of the country. Now, when we look at long-term lending, we think about our term loans, those loans that will get picked up. A lot of these are backed by SBA. When we look at these longer-term loans, when we come into a recessionary time period, an economic slowdown, what we see is a lot of businesses will ramp up their long-term lending. They'll pick up a loan that would have terms that are extended out to make sure that they have cash flow in times where they may be a little bit leaner. Remember, credit markets are open. They're able to get to this capital now, but they're well capitalized. And so when we think of that capitalization rate, that means that they don't need as much. And so lenders are, again, looking for opportunities to grow their portfolios. But at this point, a lot of the small businesses have the amount of credit that they need. Their credit is at a higher rate, so they're not as likely to go out and get even more credit at a high interest rate. They're hoping for that interest rate to come down before they go out and pick up even more open to buy as they continue through the next year. All right, so as we go to the next slide, what we'll take a look at next is delinquency rates. You know, we talked about that kind of leveling out. Well, we're also seeing bankruptcies on the rise a bit. Now, they've been pretty low since the pandemic. They've been dropping down. You know, we had the courts close a bit for a bit of time. We had a lot of stimulus in the market that kept what we would consider zombie businesses performing. That means they didn't really have consumer cash flow or customer cash flow that was keeping them in business, but they were able to go out and get really cheap funds or stimulus to be able to keep this synthetic cash flow going so that they didn't have to file for bankruptcy, but kept their operations moving along. Well, as that thins out for small business, just as it did for consumer or is doing for consumer now, we see more of those bankruptcies starting to roll to that final disposition. And so we're seeing more of those move into the Chapter 11 stance. We're going to continue to see that trend rise as we get into the next year, as a lot of these mid-sized businesses that were held up by stimulus may close their doors if they're on the fringe, more in that discretionary spending set for the consumer, and the consumers are pulling back on that discretionary spending piece and moving more toward what their core needs are as inflation drove prices up. So you'll see some of these businesses that were really on the fringe start to file more for Chapter 11. Now, we're not going to see a giant spike just because we had a lot of business applications for sole prop and micro businesses that are out there. So if you have an Etsy store, you know, an account that you're out there, or you're working your eBay, or you're a gig employee out there and you're driving around an Uber, if you decide not to operate anymore your business, you don't always file for bankruptcy. And you don't always say, hey, I'm closing my doors. You just turn it off and walk away. So we'll see this tempered, even though we may see businesses close at a higher rate because there's a lot of young businesses in the market. And I think that we won't see, it'll be tempered as far as what we see from a bankruptcy position. So let's go to the next slide, Gary. So we're thinking about bankruptcy here. Oh, before we do, let's go let's look at this one first. So we'll talk about small businesses and how they're behaving differently. So we talked about, from a regional perspective, what we were seeing in the South. We talked about also what we were seeing as far as originations and different types of products. So both the unsecured and the secured types of lending products. What about across industries? So when we look at industries, Michael mentioned this a little bit earlier. And he spoke to some of the supply chain, and even I talked to some of the supply chain challenges that we're seeing out there. What this chart does is it looks at year over year what we saw last year from a delinquency breakdown of the businesses within each of these industries, and what we're seeing as of today. So you'll see as the yellow bars and the pink bars increase, that means that we're seeing more of these businesses in these particular industries roll into higher delinquency buckets. So as businesses grow, think about this too. Over the past couple of years, we've had a lot of new businesses in the market, and with stimulus, they can continue to grow and their longevity increases. And as they get bigger and bigger, a larger business, when you think about how you're going to pay your bills, and as a business gets bigger and bigger, our largest businesses start to slow down their repayment processes. They're going to repay you, but they take a little bit longer to do it. They hold on to their money a little bit more. So those 30-day delinquencies increase a bit more when the economy is cooking along pretty good and as they get larger. Our smaller businesses don't have that luxury, so they really are based, and when we look at that segment of the business, if they start to get in trouble and the delinquencies start to rise, they're going to roll into the next buckets. So we do monitor that, and construction's a good one with a lot of general contractors and subcontractors in that space. We do see that a lot more of those as we have impacts of commercial construction and our residential construction kind of compact a little bit, slow down. We do see delinquencies rise, certainly in that particular industry. Now, along the supply chain, we talked about that. You'll see a couple of those industry groups in squares here toward the bottom. We look at retail or wholesale industry as we're looking at, are as many orders coming through from our retailers, and are the warehouses that are storing those wholesalers that are ordering to send that to the retailers, are they getting as many orders as they have in the past, and are they able to keep up with their repayment activity? If a retailer isn't ordering as much from a wholesaler, they may be sitting on a little more inventory than they need, and so delinquency levels are likely to rise, and we're seeing some of that activity happen right now. We'll also see some in oil and gas, some increases over the past few months, but I think that will change a bit. We're going to see oil prices go up just a little bit more, probably between the $70 and $90 range per barrel as we get into the first part of next year. We see some slippage in that, but an increase will likely be there. That'll keep those pumping. Now, if it gets down below that $60, $50 mark, what you'll see is a lot more delinquencies arise in oil and gas because of all of the borrowing that goes in and the pumping costs that are there. You'll see those delinquencies start to go up. But we should see over the next year that loosen a bit and delinquencies come down as we get into next year. And certainly as we're trying to bring that inflation down a bit, lower fuel costs are certainly helping that. All right, let's go to the next slide. So want to give you just a view. So we talked about utilization going up for consumers. Utilization is going up for small business owners too. Lower income segments, it's certainly above that 33%, which starts to impact scores. When we see delinquencies in the 30, 60-day range, again, that's going to bring down scores. Our scores have been artificially elevated because of all the stimulus that's been in the market. Now they're starting to normalize. And you can see here from a business owner perspective, scores, consumer credit scores. So on just the guarantor's personal credit, their scores have come down about 1.6%. We look at the businesses themselves, they've come down almost 4.5%. So it's looking at the normalization of the market, and again, some additional leveraging of credit has started to depress scores some. So if you're a lender, you may look at where your tier cutoffs are and evaluate if there are changes that you need to make to continue that loyalty with that customer who may just be spending a little bit more. An opportunity also to say, hey, if you're spending up to this level, it might be a good chance for me to offer you another card depending on the velocity of that increase. So when you guys are thinking about it, we're going to give you a poll question here real quick. When you guys are thinking about your credit lines that you're offering, trade credit for your customers, are you thinking about over the next few months here tightening credit? Are you going to loosen it up? Do you feel like it's a time to grow your portfolio? Or do you think it's a no change? You're just going to ride with your current policies. We're going to have you guys take a minute here, give us some feedback, and then we're going to show you what we're seeing from the Senior Loan Officers Survey that's come out most recently, that is surveying lenders and looking at how they are really considering the market at this point. Is it tightening or is it loosening? All right, Gary, how we doing?
Yeah, we've got about 54% voted. I think next year in an election year, I hope it would be a little more than that. But please remember to vote, folks. I'll give you a little public service announcement here. Vote.
There you go.
We love democracy here at Experian.
That's
all right.
right.
We're up to 63% voted. I see a trend coming here. I'm going to close the poll. Keep us on track here.
All right, thanks, Gary. Yeah, I'm excited to see what all of you are thinking too. So we're looking, so tightening credit 54% and no change. So more of a heavy feel, certainly here to limit any exposure as we get into the next year. And certainly that seems very reasonable as you're evaluating what the exposure would be as consumers start to limit their spend. We see delinquencies on the rise. It's an opportunity to kind of pull that in. Now let's look at what we're seeing from an overall market view from a survey done by the St. Louis Fed. So when we think about credit tightening, there's been a big trend to tighten from the perspective of just what we did in our poll. Do you feel like it's time to tighten? That has been going up over the past couple of quarters, but it's actually come back. So we've seen some openness to loosen criteria as it looked like the markets were getting a little bit better. There's not a recession that's in the near term. And so when we look out, lenders have said, all right, well, maybe it's time to grow a little bit more, look at opportunities to evaluate my underwriting criteria, and let's not let all of this fall to the side. Let's make sure that we pick up some of this opportunity to continue to maintain our portfolio or grow. The market, certainly small businesses are seeking a little bit more than they were. So an opportunity as they look out into the future to have a little bit more interest in securing some long-term debt there. But what you'll see in the top right corner is that not all the needs of the borrower are being met because they're going to their primary provider. And when they come back out, they're saying, all right, well, the exposure from the lender has been limited by tightening criteria. Am I able to get another loan? Sure, I can go to another provider and they'll risk price me appropriately, and I can still get a loan, but I'm not getting it from my primary provider. So I think the challenge for borrowers is it's not the ease of credit just isn't there where it was before. Let's go to the next slide, Gary. So when we wrap this up, recession, we've talked about it. Oh, it's always there, but I think we'll see a slowdown. There's certainly some opportunity for us to have a soft landing here as we go forward. Consumers and small business are relying more on credit. That's going to bring some downward pressure onto credit scores. So if some of you are looking at originating or continuing to grow your portfolio, you need to look at your risk tiers and make sure that you're pricing appropriately, but also that you're not losing some of your best customers just because of some of the usage that they have and the price pressure that they're going to have from inflation. on buying the same things that they've always bought. So look at an opportunity as we go forward to engage and create that legacy partner. And I'd say credit markets are still open. So even though we've talked about tightening and we've seen from a high level financial institutions, some of our largest ones, tighten a bit, they've created product lines where they can capture some of that volume that's been dropping out of their top products into some subsequent products. And then we have a lot of fintechs and small business lenders that are out there available, different types of innovative products that are catching some of these that are falling out of the standard financial process. So credit markets are still open. And as consumers continue to spend, we'll see small businesses continue to thrive. We'll just be a little slower over the next few quarters as we go forward. So we'll certainly look out to see how we'll be toward the end of the next year. And again, I agree with Michael as we look out that the Fed's probably not going to call in any cuts to interest or cuts to the federal funds rate until we get later in the year. All right, so we'll close it out there. Gary, I'll turn it back over to you.
Thank you very much, Brody. So we had a couple of questions come in, and we've got a few minutes remaining if you would like to pose a question to the panel. This question, the first question, comes from Felipe, and it goes to Michael. And the question is, with China's financial downgrade and Europe's entering into a recession, what impact will these two markets have in GDP and employment for the US? Michael.
Yeah, it's a timely question. Obviously, we've got the news from Moody's that they've put a negative watch on China's sovereign debt. I don't think there's anything new in that warning. I mean, I think the problems in China's real estate sector are well known. They're facing a lot of structural challenges as well. You know, growth really slowing over the medium term there as they work through kind of these structural issues. First, dealing with the legacy of too much debt and overinvestment in the real estate sector. But also as they transition to a more sustainable growth path that's less dependent on central government investment and more about you know, driving private sector innovation. That's really kind of the economy of the future for China. So we've talked a lot about these challenges. I think the main risk feeding back to the US economy is not to do with financial risks. So China's actually got a very closed financial system, and there's not many close financial ties between the US and China. The bigger risk is, of course, China's role as a key demand, you know, key consumer in the global economy. So, you know, we built in some downside to US exports, reflecting the weaker global growth picture, you know, the recession that we've got in Europe, but also, weaker growth in China and risks around that. But I would say, you know, it's a mixed picture really for the US, because you get some weakness of exports, but also China's role as a key commodities, you know, source of demand for key commodities is a crucial role here. You know, you could see big swings in energy, metal prices, and you know, as Brody was alluding to earlier, you know, that creates winners and losers. You know, maybe you get faster disinflation, you know, that helps a lot of consumers, but then you've got to be worrying about the credit risks there for US oil and gas producers. So yeah, a mixed picture, I think, a mixed bag.
Very good. The second question from Clark. Clark asks, growth in Q3 appears to be such a big outlier. What caused that extreme unexpected growth?
Yeah, so Q3 GDP growth above 5%, unusual to see figures that strong. I think this is just another case of cautionary tale of relying too much on any one data point. You know, a lot of the other evidence we have on the economy suggests that growth was very much weaker. So if you add up the size of the economy on the income side, for example, you'd get growth of 1.5%. So these things purport to measure the same thing, but you get very different answer focusing on one rather than the other. I think, you know, what we prefer to do here at Oxford Economics is look at a broad range of indicators and tell a more general story about what's happening to the economy. And I think that, you know, the direction of travel there is pretty clear that the economy has been slowing consistently this year. I mean, in Q3 GDP, I mean, the couple of things that stand out to me in the data is there was a big contribution from inventory restocking by firms, and that kind of goes against a lot of what we know about the state of those inventories now looking a lot healthier than they were, let's say, a few years ago. So we'd expect that contribution to actually be coming down. So I suspect that's more a measurement issue than reflecting an actual trend. And there was also a big rise in government spending as well, which again we know that is set to reverse over the next year or so based on kind of the announced policies. So I think some one-offs there, but also the bigger point, just not to get too hung up on any one data point and look at the broader trend from a range of indicators.
Yes, very good. Okay, well, I think we're going to have to leave it there, folks. We would greatly appreciate your feedback after we conclude the webinar today. So please complete our short exit survey. If you'd like to talk to Experian about these insights and the Main Street report and the many other insights that we offer on small business credit health, there is a question there about engaging with Experian about that information. Would like to thank Oxford Economics. Thank you, Michael Pierce, for putting such hard work into the Main Street report this quarter. Really appreciate that. You can find out more about Oxford Economics at oxfordeconomics.com. And to find out more, where we are, experian.com/B2B. And check out our Commercial Insights Hub. We've got lots of great insights there on small business. And everyone have a peaceful holiday season. We'll see you next quarter.